Be Wealthy and Smart, episode 527.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the 5 best dividend ETFs for 2019. And this comes to us from Investors Business Daily. Now, Investors Business Daily has given us a chart that tells us the ETF, the symbol, the year-to-date return, the 1-month return, the 3-year average, and the 12-month yield. Why dividend ETFs are important is because they can add a nice boost to your portfolio without adding a lot of extra risk. Dividends, of course, are cash sums paid by established companies that typically are not growing as fast as a younger or smaller company. For example, Exxon is one of the largest companies in existence, and it also pays a nice dividend of 3.5%. It's not the fastest growing company, it's already enormous. So it doesn't have to reinvest back in itself, and that may not be the best use of its funds. Instead, they've decided that paying a dividend to shareholders is a good use of funds. And that's because it can attract institutional shareholders, it can attract more large, conservative, long-term shareholders. And so they've chosen to pay a nice, healthy dividend and reward shareholders for being a holder of their company. Companies that tend to be high growth companies like technology companies or biotech companies tend to reinvest in their company because they're growing so fast that they figure they can get more bang for their buck by investing in their own stock or reinvesting in their expansion. For example, growing more retail outlets or creating new products, new services, and that's a better use of their money to continue to expand their revenues and their profits. And they're right. So not every company is going to pay a dividend. It's going to tend to be the more established companies that, again, aren't growing as fast, but are very stable, large companies. What we see in this chart is that the S&P 500 is up 10.1% year to date, and this is as of February 18th, 2019. So the S&P is up 10.1%. The 1-month return for the S&P is 6.2%. It had a very good January and half of February. For 3 years, it's up 16.2%, and its 12-month yield is 2% on the S&P. Many of these dividend ETFs are paying more than the S&P 500. So if you want to have a substitute for short-term bonds or intermediate-term bonds, you can consider adding some dividend-paying stocks to your portfolio because they're not subject to interest rate risk. As you know, bond funds go down in value when interest rates go up, so you have interest rate risk with bond funds. A dividend yield gives you another source of income similar to a bond fund, but you don't have the interest rate risk. What you do have is the risk that the companies can reduce their dividend. Some companies may fall into financial trouble and not be able to pay their dividend. And remember, these are ETF. They are also going to have very low expenses, typically lower expenses than mutual funds would. And the mutual fund portfolio might be changing companies in their portfolio, but you're paying that extra management fee for that, sometimes 1% to 2% extra per year. Whereas an ETF, you're getting the low cost, no management, but you're paying the absolute rock bottom that you can for a diversified portfolio of dividend-paying stocks. What's interesting to note is that 2 of these ETFs actually pay more than 8% as a dividend. That would be the Invesco KBW High Dividend Yield Financial, KBWD is the symbol, and it's paying 8.3%. And the Global X Super Dividend, symbol SDIV, is paying 8.2%. So that's a very, very high dividend. And I don't always recommend choosing an investment by a high dividend or a high yield. There's usually some good reason why there's extra risk there, or why there is such an outlandish difference between them and other companies. Without really delving deeper into what's in these portfolios, I can't really answer that question. But I definitely wouldn't just choose something based on its yield alone. This article actually ranks these dividend ETFs by their year-to-date performance. So it's showing the WisdomTree US Small Cap Dividend as the number one dividend ETF, up 13.6% year-to-date, symbol DES, and it has a yield of 3.3%. Interesting to note is more than half the dividend ETFs making this list are beating the S&P this year. Also interesting to note, there's only one REIT in here, Real Estate Investment Trust. It is the Global X Super Dividend REIT, symbol SRET, yield 7.6%, and it's up 11.1% year-to-date. There's also a dividend dog fund in here, which is when you buy the worst performing companies of the Dow Jones Industrial Average, and you put those in a portfolio, those have the highest yield. So we have an ALPS Sector Dividend Dog, symbol SDOG, up 9.8% year-to-date, and it yields 3.7%. We also have an uber low-cost ETF in here, the Vanguard Dividend Appreciation Dividend ETF, and symbol VIG, up 9.5% year-to-date, and it has a 2% 12-month yield. So I'm not going to read all of these performance numbers to you. I know from the survey that's not one of your favorite things that I do, so I'm not going to do that this time. But I will post this chart in the show notes, and you can look at all the companies and do your own research. I do think it's a good idea to have some kinds of dividend-paying companies in your portfolio just to provide that extra cushion, because no matter what the stock market does, whether it goes up or down, you're going to have some of that dividend paid into your portfolio. So you can make that 3% return or 4% or 5% return from dividends, and that's a nice cushion. And again, you don't have the interest rate risk that you do when interest rates go up and bond funds lose value. So just another something to consider for a portion of your portfolio. Please don't buy anything based on what you heard here today or thinking that I'm recommending this for your portfolio. Always check with your financial advisor before making any purchases. If we haven't yet connected on Instagram, come on over to instagram.com/Linda P. Jones and get my daily tips for financial freedom. And I'm happy to say my book is back in stock at Amazon. You're already a wealth heiress, now think and act like one. 6 practical steps to make it a reality now is available at Amazon in the US and Amazon.uk if you are an international buyer. And if you're outside of both of those areas to purchase, you can go to my website at lindapjones.com and purchase the book on my programs page. Don't forget, we still have our review contest going. I've added an additional 15 prizes by the end of February. So 5 additional Wealthy Mindset Blueprint audio sets valued at $197, 5 additional Wealth Heiress books personalized for you, and 5 additional wealth mentoring sessions with me valued at $500. And all you need to do is leave a podcast review that gets your name in the drawing 5 times. If you leave a book review on Amazon, that gets your name in the drawing 7 times. And if you do both, you get your name in the drawing 10 times. And if you've already left a review, you're still included in this drawing as well. So we'll have one drawing at the end of February, and we'll have another drawing at the end of March. So don't wait, get your reviews in so you can be included in that contest, and you have a good chance of winning. There's so many prizes I'm giving away, you really do have a good shot at winning. If you haven't yet completed the survey, please look at the show notes and complete a 10-question survey so I know who's in the audience and I can better tailor make shows for you, and let me know what you think of the podcast. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. share the wealth, and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.